Good evening, everyone. This is Doug with another swing presentation here. It's Wednesday, November 2nd, and let's get right into it, okay? You all know this, but got to do it. Just so you know, nothing presented in this webinar or video presentation, whether vocally or visually, is to be taken as trading advice. Everything here in this presentation is for educational purposes only. You should consult your broker or financial advisor before placing any trade, but hopefully you're consulting yourself first and foremost. This is your job, your business to make the money, and of course that requires your own judgment, your own confidence. What does that require? Homework. Okay? And of course, after you've done all the homework, after you got that confidence, still remember, never trade any market with money you cannot afford to lose. Okay? All right, so let's get started. This is a swing trading Q&A, okay? And just to reemphasize, in case anyone was unaware, is coming in late, doesn't know, didn't get the email or the message, this is a recording. So I won't be able to answer your questions. So please, if you're planning on typing any questions, just don't. We're trying out this new thing here. Steve wants to start doing some recordings, and of course we're also going to be keeping it shorter than usual. I know you guys will believe it when you see it, but I promise this will be under 2 hours. I kid. We'll see. All right, so like I said, this is going to be a Q&A format. I'm going to be addressing a lot of questions that have come in from Skype, from the email messages, chart markups, flashcards, and a lot of it's actually going to be kind of covering some of the basics, but more in depth. I'm going to be doing more charts. There's actually very few slides in this presentation, so I think you guys will enjoy that. So that's about it. Q&A session covering most common questions that I get and lots of charts. So let's get going. First question, please. Okay, now I know this seems like a basic question to some people, but it's a point of confusion for some. So just to clarify, because we're going to be going over a lot of chart examples, confluences are simply a series of events happening at once. All the stuff I've talked about, a peak formation occurring at a quarter point or 50 pips above or below a quarter point, which includes 50 pips in front of a quarter point, like before the quarter point is actually reached. That seems to be a little bit of a confusing point. People always think that it has to do that trap through event, but that's not actually true. It can stop dead 50 pips before the quarter point. Other things, okay, the blueberry is crossing into the quarter point, or the mayonnaise is crossing into the quarter point, or one of those sweet spots. A confluence of divergence with those things that are happening, the peak formation at the quarter point, plus you have divergence, shifts away, comes back up, gives you the second leg, that gives you a baseline bounce. Those all stuck together. Those are your confluences. Now the AOIs, they're the actual places on your charts that you're looking for the confluences to occur. So think of it as the physical areas on your chart. Okay. I mean, there's really no other way to say it, right? So your areas of interest, this is what I want you to focus more on this, because people kind of get the idea of like a confluence of events, that multiple things are happening at once. All right. The areas of interest, just so you know, okay, on your TDI, what do you have? You have your market baseline. It's an area on the TDI that you want to focus on. Is the RSI coming back into that? Ooh, better watch it. Upper bands, lower bands. I should have put the lower bands there too, specifically for the trending that I talked about in regard to watching where your resets are going to be occurring during your trend, how it hits the fixed 50. That's up there too. And of course, your extreme, you're overbought and your extreme oversold. Your moving averages, it's another area. Specifically, you want to focus on that for projection. And most of you get that point. You all know that, because, Carr talks a lot about, okay, after this level, you're looking for what? An H1 50 bounce. After this level, you're looking for what? A W or an M off the Mayo. So a lot of you are kind of in tune with looking forward and projecting out and seeing, okay, there's my moving average. I'm waiting for price to come back to this area. Or I'm waiting for price to hit that area before it rejects. So if you can understand that, you have the whole concept of areas of interest down pat. There's just other areas that I look at for the swing stuff that you need to kind of get it into your bag of tricks. Another one, the price points, the quarter points, the 50 above, 50 below quarter points. That's an area. It can be part of the confluence when it hits those areas and does your setups, does your peaks, does your safety at those areas. But it is an area of interest that you need to be looking at. Aha, I think it's going to be hitting that quarter point tomorrow. Or once you take a trade, I'm expecting it to go down to this quarter point or down to this area. And speaking of actual areas, that involves heavily looking to the left. And I forgot to put that in there. 2TL, you'll see that on my charts all the time, to the left. So your trap to volume, your D1 trap, Jim talks about that a lot. Your H4 safety zone, I touched on that. We're going to look at some of that today. And of course, looking to the left for your first leg. That's not level 1, but your first leg, specifically of a larger structure or an intraday larger structure, 3x3, that kind of thing. So you have to use both of these in conjunction, especially in terms of projection. All right, I talk a lot about looking to the left, but just recently I had a conversation with one of the DMR fellas by the name of Attikin, and I used one of my abbreviations, 2TR, to the right. And he's like, well, what do you mean for to the right? You got to be able to look to the right for your projection of certain things, specifically for the MAT, the moving average tug that I talk about, where they're holding a level, they're holding an area. The price, when they're holding the price in order to bring the blueberry or the mayonnaise down into a level where they can smack into that before they drop or before they rise. You should be able to look to the right and see not just the moving average, that blueberry is coming down into this area, they're headed back up into that blueberry, but also, wow, the blueberry is about to cross over the quarter point, that kind of thing. And that's about to happen maybe tomorrow, maybe in 2 days. It's Monday. That might happen on Wednesday. They give us a nice midweek reversal. But also, at that quarter point to the left, there's trap volume. There's a nice, failed peak over there. So you might say, I wrote a nice little description down there. I know a lot of people are kind of not up to snuff with my abbreviation, so I'll just read it. You might get to your chart and go, oh, look, there's a 3-day wide intraday larger structure. I got a second leg that's put in. The railroad tracks of the second leg is at the quarter point. We have nice big divergence, okay? The second leg extended. That's where the second leg goes below the first leg. And the second leg has given us a baseline bounce. And, there was trap volume over to the left. Not to mention it's Wednesday, so... the railroad tracks just spiked below the lower psych levels as the trap move. So now we got the cycle synergy that I talk about, midweek reversal. Okay, so that's what I'm talking about when I'm talking about the confluences at the areas of interest and projecting out to the left. To the right. Okay. Next question. Actually, before we move on to the next question, I did want to go to a chart example just to explain, confluences and, the areas of interest. So one moment while I take a swig of water, take a look at this and see if you can spot some of the various confluences that I was just talking about. Okay, so far I see the 3 pushes down. Obviously, we're coming out over here. You see one push down, they hold, another push down, pull back, shift down, right? Then we start to get one of these smaller, larger structures, more of an intraday larger structure / 3x3. But we also see a harmonic, and if you remember from my the one of the presentations where I spoke about how I leave harmonics on the chart in order to see how they handle that area a couple days later, or maybe even the next day, maybe even the next session, because sometimes you get those tiny little harmonic boxes. I know you all see them, and they probably frustrate you because, well, how the hell am I supposed to grab a little pattern in there? Well, this is one of those things. They create that harmonic area, or the box. The indicator creates the box that shows you, hey, this is an area of interest. Watch this area. So what do? A couple days later, they come back, they smack into it. Now, this might be a little bit tricky for some people because, they close at the extreme of the structure on Friday, and then they push down. It's very, it's kind of tricky, all right? almost false move weak beginning. It's so damn quick. Okay, they pull away, and then it's just up, up, up. Okay, but let's take a look at the 4 hour. And now we can see, does everybody here see the larger structure going on? Now I talk about these extensively. I love the larger structures. Okay, so we get our first push down. Wide range swings, it happens. I'm not telling you to take it from here and sit through all this. That's not what I'm doing. What I'm telling you is that we can see that they've pushed down 3 pushes. 1, 2, 3. Okay, we get a harmonic. They give us a second leg in the harmonic range. They give us on the H4, it's a little bit over the baseline, but a baseline bounce, baseline shark fin, kind of the same thing if it's in the proper context. We see this trap area. That's the last place people got screwed. What do? They stay right off of it. They just touch the top of it, don't they? Let me change this. Actually, let's change it to green, indicate long. Okay. When I see this kind of behavior and then they shift right up out of here, my brain immediately, okay, if we do the hard right edge and actually take off auto scroll, all right, I don't know why it was kind of acting a little wonky there. I immediately see the potential. I see, oh, that's the mid structure middle. Remember I was talking about the larger structures that were that contain, for example, the exact mirror opposite of the top or the bottom. So that was kind of a weird way to say it. So say you're looking for a potential larger structure M pattern, right? If you get an M, you're going to get a nadir, aren't you? So your nadir is typically a W. Now, yes, it could be a single leg. I've had some people say, well, I see these single legs. Yeah, it can happen. You'll get single legs and shoulders. But ideally, I mean, when you see this, see, the whole point is being able to see something and going, oh, that's it. Not just guessing and going, oh, I think that's it. But when I see something this clear and everything's lining up, we have the baseline bounce. It's at trap volume. It's a 2LX, as I write. A second leg extended. The second leg goes a bit below that first leg, so we got the second leg extended. They trapped at the very end of the week and then rolled over. That's the kind of thing that you can look at and go, they're giving me a second leg, or they're giving me the middle of a larger structure. I'm expecting them to go back up. Now, obviously, you can see this is the kind of structure that you can just see. Oh, it closed above that 13. I have everything else is lining up. I'm good to go. Take it. Now, you could just get out at the quarter point because that's part of the projection. What kind of area am I looking at? Well, it is New Zealand CAD. For those of you that didn't notice, it is a pair that can typically do this kind of stuff and take 3 weeks to get up to the next quarter point. So you can scale out at the quarter point. You could get all out at the quarter point and look for your next move. But because this is so clearly a larger structure, you may want to hold on to the trade up until you get up until that up into the area of that first leg. Again, you got to make a judgment call. A lot of this stuff you have to make a judgment call. There's nobody that can give you 100% accurate rules that are going to work all the time. You're going to scale out at you're going to close out at a quarter point and it's going to go to the next quarter point. You're going to hold on to the second quarter point and it's going to stop and jerk around for 2 weeks at one quarter point. You have to make the decision. But ultimately, when you see this, I mean, the larger structure here is so clear that it's a very safe trade. As you can see, I mean, it even broke that first leg. So we'll get on to the next question now, but I just wanted to cover a nice snippet of what I'm talking about when you have all those things aligned right at an area of interest, you know, because real quick, once again, I don't know where my hard right edge went. When you're projecting, if you see this coming down and you see this out, you're going to be looking to the left, you're going to be drawing this stuff out and seeing where everything is. And you're going to be saying, yes, it's a multiple, I was going to say a confluence of areas, but it has all the properties that you're looking for. And I think one more thing, let me go down to that H1. Okay, everything's just kind of lagging a little bit. And also, did anybody notice the sweet spot that is 50, 100, 150, 200? This is another area. Remember I said 50 above or 50 below a quarter point. So, I don't know, there's like 6 or 7 things right there that just lined up, combined with the very powerful fact that it was the middle of the larger structure, and you're golden. Okay, so now on to the next question. Okay, this one kind of surprises me because the entire system is based around, the market maker cycle, the 3 up, 3 down kind of thing. Although I understand that presents people with a lot of problems because, especially when you get into a trend, you don't see those. They tend to be in the more range-bound markets, the perfect clear 3 up and 3 down. But really, the larger structure is it's simply an M or W that occurs over, a week or two, up to a couple months, actually. And you can see some that are 4 or 5 months wide. It just, people get lost in the noise and they don't realize that a larger structure is occurring. So, real quickly, here's a larger structure M. Just imagine that this is occurring over a couple weeks. First leg, second leg. First leg of larger structure, second leg of larger structure. Those are the abbreviations I use. I have covered this. I know some people might be like, oh my God, I can't believe he has to cover this. But, I do. And we always have some new people coming in. They may not have watched all my videos yet. Okay, and then, of course, this is the MS, the middle of the larger structure, as we just covered in that New Zealand CAD, for example. Now, this is your more accurate representation of the whole thing. So, people will ask me all the time, like, yeah, well, but how do I know it's coming? How do I see it? And, like I said, at first, I was like, what do you mean you can't see it? Well, one, you have to do the homework. As I said in another presentation, I pretty much only flashcard larger structures and P formations nowadays. Because once you see those P formations begin, once you truly get the P formations under your belt, the rest of the stuff kind of falls into place. And the whole idea is to really know the difference between like a solid P formation and just like, oh, well, it looks like level 3, but what do you know? It keeps going. It's the same thing with the larger structure. And my biggest tell for a larger structure is the middle structure. I'm not too worried about catching this. Because sometimes this is just a single leg thing that happens and then this starts to happen. I just wait for this. And I wait for this. I'm not worried about this. If I see a clear intraday larger structure on the first leg, which is one of those clear 3 up, 3 down kind of things that you see across 2 to 3 days, there's been a lot of them recently, then okay, fine, I'll look to take that. But otherwise, I just wait until I see all those kind of confluences we just covered on the New Zealand CAD for the middle of the structure. Second leg, there you go. That's the kind of stuff you get. Now, here's the further breakdown. Now, I want to ask you, if you can see this, if you studied your larger structures, if you can see this, what are you expecting? You're expecting this. It's as simple as that. So that's why, I'm kind of like, well, because honestly, the real answer is you got to do more homework. When people say, well, how did I miss this? How do I see it? It's because you haven't done enough homework. I just spoke with someone today, actually, and they were showing me some trades. And I know this person, I know they have been doing homework, or at least they started. I'm not going to name any names. I know that they started and they were doing it, but I have a feeling they got off of it and just, started hitting the trades, of course. And there's nothing wrong with starting to hit the trades after doing, a month of homework, but don't stop. That's a common error that people do. They go, okay, I'm getting it now. I'm seeing this stuff all over the place now. So instead of saying to themselves, wow, I'm really seeing this stuff, let me keep homeworking it, they just kind of go, oh, I get it now. I was a huge proponent of that methodology. Do some homework, understand what you're seeing, say screw the homework, and then you start trading. So that's really the answer, is just to keep doing homework. And I know this person sees the moves, but I saw a bunch of trades that were basically, they were entering and they were getting out after 2 pips. And I'm not being, hyperbolic here. I'm not exaggerating. And it was crazy to see. And that just tells me there's a lack of confidence. If you are doing that, if you're constantly entering trades and you're just getting out because you're not sure, that right there is the biggest indicator that you just need to study more. So that's the answer to this question of, what exactly is a larger structure and how the hell am I supposed to see it? Don't worry about the first leg. Look for that first portion right there. Look for that first portion. And when you see that, especially, I love these second legs that go below for the middle of a larger structure. They're gold. They are absolute gold. Okay? Okay, we're just going to take a brief look at a couple of the larger structures just to illustrate my point. So when you see, for example, burst, 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 okay, now they hold this level and they give you one more final burst before rising up. Do you see this small W here? It's not as wide and as perfect as it can be, as that New Zealand CAD was before, but what else do we have? Well, we have a couple confluences. We have the blue tracer. We have the quarter point. We have a small baseline bounce and a shift up, okay? So if you're taking a look at that on the hard right edge, you just got to your computer. Sorry. You just got to your computer at that point in time. There you go. Yeah, they gave you 3 hits to the high, and they could continue, but everything else is there. We have previous trap volume over there. They really worked that quarter point to the left, right? You see that, and we also have a little failed candle there, which I've talked about before. That candle, that little red candle there that you see, and I'll zoom in for you. That red candle there tells a lot of people that it's about to continue. And this wick sure as hell confirmed that to a lot of people right before they took it all away. Because it's breaking that previous price point. It's breaking yesterday's low. But we wait. And we get the confirmation that it rejects, it traps people below. Second leg extended. I know it's tight. But we've projected out. We're at our computer going, you know what? This is... The moving averages are all over each other. It's kind of range-bound territory on the H1. They're working that quarter point. We got a baseline bounce. We have a mid-structure, a little W here. This is it's presenting a possible larger structure M formation. And what do we get? We do get that 3, bam, up, hold the level, burst, 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 wedge, and then a final burst. They stay off this trap volume, they stay right off the quarter point, and they start pulling away. Now, what else do we get? Let's just take a quick look at the rest of it. Massive divergence, we start getting a baseline bounce. Now, this works briefly, but man, don't they come all the way back, but they do stay off that trap volume. They hit that tracer before they roll over, and then it's game over. Down to the next quarter point, and beyond. Okay? Now, this is a perfect illustration. Do you take at the quarter point or do you not? Now over here, you can make the case for, well, this wasn't really a larger structure. This is why I love the larger structures. Look at this. Over the course of a month, they held this level 3 for 2 weeks, dropped down, hit it again, couple more inducements. They failed to continue. How many people thought the trend was going to continue up there. They just held one little ping and then shifted over. You see that kind of momentum coming out of a second leg of a larger structure that pretty much spans 4 weeks, then I would look into holding. Okay. Now let's take a look at, say, New Zealand back in April. Perfect example. There's really nothing here. Don't get pissed off that you don't take that. But it is 50 pips above. It's 50 above the quarter point, which I like, but there's nothing. I'm not taking this. There's like 3 points of divergence. It's not a big deal. Because when I see this kind of single leg and I'm expecting this kind of move, especially when they give me this, second leg extended right at the blueberry. Look how they hold this level. 3 blue tracers pretty much on top of each other. They trap move end of week. They gap up. Am I taking it here? No. But I don't care because I'm waiting for this. I don't give a crap about any of this. I'm waiting for this. Once I see this shift pending, cool. Pulls back nice and big, hits that tracer one more time, starts to shift over, add into the position. Hold it as long as you want. Now, you have the options of taking off at the middle. So a lot of times they will fail at the middle when they reset. So that's at the end of the day. You start seeing this kind of behavior. You want to get out? Fine. You just grabbed, let's say, you did the 50% pullback. You're out over here, let's say 174 pips. Let's say you just want, sorry, my platform is cutting in and out. You just grab it down to this sweet spot. You're looking at 165 pips. The platform just froze up there with the crosshair because it's connecting and disconnecting. Sorry about that. So there's a bit more on the larger structure as far as the examples go. And as you can see, when you combine the larger structure, the synergy of all those confluences at the areas, it's all right there. This is when you see it this clearly, and it's available to you across a bunch of the pairs, pretty much every month. So if you're grabbing 150 pips just off of one pair, if you really wait, for the supreme setups, you don't have to worry about hunting for anything and second guessing yourself. Wait till you see it this clearly. But of course, you need to do a lot of homework on it. So you can just eyeball it and go, bam, that's it. All right, on to the next. Okay, so I understand that I understand why this is confusing because you tell people baseline bounce and they start thinking, well, it rejected off of the baseline there. That must be good. That must be good. And a lot of times they are, but they might only be good for 30 or 40 pips, which is perfectly fine. If all the stuff here you can use to trade just 30 or 40 pips, and you're probably going to get them pretty damn quickly because all this stuff that I look at, they are identifying factors of, hey, this stuff's going to move. But sometimes it can hover and go up some additional pips, obviously. For example, this example right here. Now, here are the rules. And I'm not going to go 100% too deep into it. I'm going to be giving more of a presentation this Sunday in the study group. So if you're not part of the study group, sign up now. But also in the near future, I'm going to be giving a more elaborate presentation on baseline bounces. But take a look at this, all right? Right here. This would qualify technically as a baseline bounce. Why? I want to see 2 to 3 days of divergence, at least, okay, before the baseline bounce. Now, actually, no, I'm sorry, I misspoke. Technically, this doesn't really qualify because it doesn't have the 2 days of divergence beforehand. I said this qualifies. No, it doesn't. And, typically this is why I avoid. Look, it's only 1 day. There's 3 separate bursts of divergence, but it occurs all on 1 day. The second day is your baseline bounce. However, if you look across these 2 days, we have divergence for 2 days. And then what happens? Bam, quarter point, blue tracer, little kind of pseudo core wood kind of thing. That's where we get our hit to the baseline. It does slope slightly over, but that's not a big deal. I've studied this enough to go, hey, you know what? Let me take that. All right. Now, again, it kind of sucks. It's on Thursday. I don't like to hold the Pacific pairs over the weekend. That's another thing that people constantly ask me. Do you hold over the weekend? Typically, no. Sometimes, yes. Actually, technically, usually if the shift occurs on Thursday or Friday, I will hold. But I don't like holding New Zealand, Aussie, and yen over the weekend because their banks actually, that specifically the New Zealand and the Aussie, they actually open up a little bit before Tokyo. So you got like an hour where they could be moving their own, the price of their own currency before the market opens. And if something happens, if there's something going on over there, I've gotten some bad gaps on New Zealand and Aussie, so I just don't like holding over. Now, this doesn't go down to the next quarter point or anything, but I will say I would have been looking at this and going, this is probably going to be a larger structure. They're probably going to come back to this area, but they didn't. They stopped right here and they held, and then they gave an intraday larger structure. So now I start to see this, and I go, aha. All right, they're headed up, especially with this pin right here. Trap move end of week, and they just roll over. And you all, this is the current market. You all see what's going on. But this is an example of the baseline bounce. I want 2 to 3 days worth of divergence and then the baseline bounce. So let's take a look at another one. Okay, here's a great example. This is a perfect example. And again, on a pair you might not think of. Now, I used to, for a while, I stopped looking at all the crosses and I was only looking at the majors. But once I refined stuff down to I want to see this specifically, now I can look at any pair. And if I see this, bam, take. So what do we see? Do we see 2 to 3 days worth of divergence? Absolutely. We see the divergence here. And I hope everybody sees the divergence going on, right? Okay. Then what do we get? Boom, baseline bounce. And this is one of my favorite, second leg baseline bounce. We also got some chopstick divergence here. I probably should have stuck that question in here. Some people are confused on the chopstick divergence. We'll get to that another time. But this is really important because if you just wait, if you could only take this kind of setup, when you see it specifically this clear, bam, bam, and then the second leg, when the second leg or the second shoulder gives you that baseline bounce, you're gold. Now let's take a look at another pair you might not look at. Okay? Euro GBP. Who the hell wants to trade Euro GBP? It moves so slow. Although I do hear people, well, actually now with the Brexit, all the Brexit stuff, and after Brexit and before Brexit, because of what was going on with the pound, it did have some steam behind it, right? But I still don't like to trade it on a regular basis. I'll look just for this kind of stuff. I did take this trade. I loved it. But otherwise, it's like watching, paint dry because it has a smaller ADR. But I do hear people like it because, the pips are worth more. Although that's not exactly the case. It's not worth as much more than it used to. Did I say that? Yeah. Anyway, the difference isn't as it used to be. There we go. That's the word I was looking for. The phrase I was looking for. Because of what happened with Brexit, but still, you can see right here. Once you get the days of divergence, look, Friday. Okay, it's band divergence. Then we get boom. 3 days. It's up, and it's just like, not really doing anything. I know you might look at this and go, well, technically, it's not divergent because this of okay. Well, still, we have this peak, even that is slightly with that, and we have band divergence. But we get our second shoulder, or we get our second right up there, okay? And then it rolls over. Now, it's a little scary, okay? Comes all the way back, and then it just rolls over down to the quarter point. You got 180 pips if you hold over the weekend. We get even more right here. Take a look at this. Bam, 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 bam. Do we have our divergence? Yes. We're starting to get some baseline divergence too. We get a nice W off the baseline. Hard shift. And then it's just over back up to the quarter point. They hover a little bit before they continue on up. Now we get the same thing, and I'm going to show you this. It doesn't work out entirely, but I'm going to show you this because it's a great example. Okay, and I grabbed this off of a pending right up in this area. Nice head and shoulders with chopstick divergence. Here's our baseline bounce. We have 2 days of divergence, Friday into Monday, flat line, and then what happens? The second shoulder gives us that baseline bounce. Now, of course, we know what happened afterward. But these are the kinds of things you have to plan for if you're going to be swing trading. You have to have the ability to watch and see if they're making a brick wall of price. For example, right here we can see, bam. Aren't they just flipping that zone, just riding that mayonnaise? Ping, staying off of it, ping. One more time, stay off of the previous low, ping, shift, and then it's over. So that's what a true baseline bounce is. You want 2 to 3 days worth of divergence. The second leg or the second shoulder, preferably, to smack into the baseline and reject off of it. And that's it. All right, so now we're on to everybody's favorite part, the charts. And I know in the past I've always done way too many slides and not enough charts. And this is your favorite part of everything, taking a look at the charts, because of course you want to see this stuff. So here we are. What we're going to do is we're going to take a look at just the first couple weeks of September. We're basically going to be looking at September. Another big complaint. Not from everybody, because most people understand, but sometimes the complaint comes up is, well, you're showing a chart from 2013, you're showing a chart from 2014 or 2008. Well, yeah, because they're perfect examples, and we want you to see the perfect examples to get them in your head. But it's a valid criticism, I guess. So what I'm going to do is just show you all of 2 months ago, and we'll see what we could have done with the material that with trading the market in the way that I like to look at the market. Okay, so first we're going to start off with Euro. So what do we see here? Do we see anything interesting? Well, the first thing I see is that the moving averages are pinched. That's always the first thing I like to look at. But also, I do see the potential for a larger structure. Why? Because taking a look over here, well, this is obviously kind of first leg behavior. Don't we see first 1 burst, 2 burst, 3 burst? Okay, so what do I see up here? I see a head and shoulders with the head 50 pips above the quarter point. What's happening on the second shoulders? Do I see a baseline bounce with 2 days of divergence? Yes. Okay, so that's the kind of thing you can take and you can enter on, but you have to factor in, okay, well, it is Friday. What am I going to do? Am I going to hold it over the weekend? Do I expect it to go all the way back down? We might take a look at the 4-hour. What does the 4-hour show? Okay, well, the 4-hour shows that, well, this is just garbage. So you know what? We just had this big W over here. I'm taking it on that second shoulder, but I might only take it till the end of the day. I might only take it for 50 pips, that kind of thing. Don't think that I just he buys and holds for 250 pips and that's the only thing he does. No, if I see something like this, but 4-hour tells me, you know what, you probably don't want to rely on this going straight down. I'll take this for 50 pips or 40 pips or whatever. So we do see this first burst down, and then they hold. Oh my God, all week, pin, burst up, burst down. It's just a mess. They're ranging, and then we get 2, and then into the next week, 1, 2, 3, and finally burst. Then we get our second leg of a larger structure. Now, fortunately, you've already marked this out because you are a good trader and you've done your projection and you've looked to the left. So you see this and potentially you go long because you've taken it and you see, okay, we dip down and it's scooping above the baseline. We're going to go long. How does that work out? Up to the quarter point, it works fine, but you know what? They have other plans. They want to work their crosses. They want to do their thing. So you've made some pips, made maybe 65, 70 pips up to the quarter point. Took you 2 days. If you're holding for longer, you wind up scratching out. And this is a lot of the times, or this is one of the big reasons that, I do recommend scaling out. So let's go back onto the pound. Okay, what do we see on the pound? Well, we see a nice, lovely move Okay, 3 points of divergence, I see. Now over here, wow, we got 2 days worth of divergence plus a baseline bounce. That might work. Okay, maybe you take a 50%, maybe you put your foot shoulder, take your 50% in. But when you start to notice that they're stopping dead at this area, they're stopping at a previous trap area and they start to roll over, hey, you know what? Sometimes it doesn't work. And this is why we do flashcards, because this would be a great reason, or this would be a great flashcard to have to remind yourself that, you know what, it doesn't always work out how you expect. But we get another push up, which is divergent here. And I want to point something out that's kind of a bit of a teaser for my next presentation when I really talk about the TDI. Do you see the larger structure on the TDI? T1, well, I wouldn't really call that two, but it's kind of you have a pullback, and then we get our next push. It doesn't really go below that one, but we get, in my 3 moves down, and then rise back up, and then we get that little M over here. It's almost like a 22 trade on the TDI. You can't see it here, but you can see it here. Now, am I telling you to take this up here? No. Okay. Now, another thing I want to point out is I think this would be a larger structure. Do you remember that, the middle of a larger structure? Do you remember that example that we had before? I believe, you know what? I'm not going to go look for it now. It's going to take too much time. But, oh, that was the same thing. I was like, well, what was that? It looks awfully similar. This looks like it was a potential for a middle structure heading back up. But what do? They fail on the first push up, and then they start rolling over. A common occurrence that I see all the time, but you have to be prepared for that. This is, if I'll take it. But if I catch that first level up, I just, you know what, I'll wait. Look, it pips up until I get a second leg. If I don't get it, no big deal. It rolls over, look where it winds up next quarter point before they start jerking around. All right, let's take a look at dollar Swiss. Dollar Swiss, what do we get over here? We get plenty of divergence, headed up, and then that is a massive, go to hell, retail traders. We get a nice baseline shark fin right to the upper bands, and then that second hit, boom, baseline bounce, and they start rolling over. Now they hold for like 3 days, but what do? Hit the stops low, hit the stops rise, roll over, okay? That's what they do. They will hit the stops first in the direction that they're going to go. Now, for you people watching tonight, does this look very familiar? Let's go take a look at, dollar Swiss last week into this week. What do? 1 out, right back in, hold for 3 days, okay? Hit the stops, boom, 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 ping, ping, ping. It's not as dramatic with the hit the stops low, hit the stops high, but that's what they're doing, right? Oh, look, it's going to continue down. No, just kidding. Hit the stops, drop. Ping, ping, ping. Roll over. I love it. Okay. Now, some of this stuff wasn't very clear. I understand. This is the biggest, like this, I take those kind of things because that's just a blatantly obvious, like, screw you. All right. But it's still not as clean as I'd like it to see. So let's see what happened on yen. All right, well, this is lovely. I see a nice head and shoulders. Okay, hit the stops low, hit the stops rise, roll over. They give us the second shoulder, tap into that baseline, and then one final tap off of here, baseline, they roll over. Okay, and then it's over. Boom. This is what I mean in the fact that, like, you don't even have to hold it for very long on a lot of these setups. Specifically what I look for. Because a lot of times the big moves will occur just, within a day. So oftentimes that day, especially if you get something that's, a clear head and shoulder. Now, you may be looking and go, wow, it's not perfectly above the quarter point by 50 pips or whatever. And, this is a little wonky. It's not as perfect. It's just kind of rolling over, and the baseline bounce occurs down here at the fixed 50. but it's still beautiful. I mean, that's picture perfect safety trade right there. You got a safety trade that's a second shoulder with a baseline bounce. Cash in. All right. Aussie. Okay. What do we see here? Anything? Not too much to my liking, I'll admit. All right. We do get some working below the 50 or below the quarter point at 50 pips below the quarter point over here. We got our safety trade at the fixed 50. It's not as pretty as I like to see, you know? Now, what if we take a look at the H4, see anything going on over here? Okay, well, if we take a look at that, if we look to the left on the 4-hour and we drew out our trapped volume, maybe that would have given us something to take a look at. Let's go back to the H1. Okay, I can see that now. Now, these single legs, they can be very tricky. And then I see a failed pattern right here, a nice failed W. People are thinking, oh, it's going to go long. Nice W, it's going to, it's a continuation, right? We used to call stuff like this, now it's the star pattern. We used to call it the Empire State Building. Now I refer to these things as the Empire State. To me, this looks like the Empire State. When I see that and it's at trap volumes to the left, I will get in on those. Especially, we have divergence right here. And I don't mind getting in a little deeper once it crosses that 13. I'm not worried about that. Why? Because I'm risking a percentage. I'm not going in with a fixed amount. So we see that it's hitting that trapped volume. And people are getting excited. Why? They came back to retest this sweet spot. Let me move this box a little bit. They came back to retest this sweet spot right here. Oh, right here. Oh, right here. Reject, reject. People are like, oh, I guess it's going down. Like, you can't make it past this area. So what do? Aggression. They break that sweet spot. They break the trap volume to the left and then come right back in it within a couple candles. All right. That's some of the things I like to see. So let's take a look at New Zealand. How about New Zealand? This is lovely. I'll give you guys a moment. Take a look. See what you see. Okay, so we have obvious level 3. We have many pushes up, 3 clear levels up, don't we? We have our peak over here. 1350 cross, 5200 cross, nice wide range swings, mimicking level 3, which is a characteristic of level 2. And then they burst up. Oh, now we're into level 3. Well, now we got a peak. We got this little bit of a consolidation area. We have our big peak going on, right? What about TDI? 2 days of divergence, slope under, bam, bam, second leg, baseline bounce, shift. It's over. It's over. This is beautiful. It takes you 2 days. And especially, look at what you could get on your risk reward with that. When you get that shift and you get that second, you get a little M at the baseline. Now, you might look and be like, well, it didn't touch. If it's within like 3 to 5 points, I let it slide. Okay, this is too good to pass up. Thursday, part of the midweek reversal, high test candle. You're golden. Take it down. Maybe you ride it to the end of the week. I wouldn't hold it over the end of the week. I'd probably get out somewhere around here because I'd see that shifting back up and go, you know what? End of the week, there's my trap move. Let me get out. 130 pips. Look at your risk reward catching it up that high with that high test candle. You're golden. Dollar CAD. Okay, right here. Baseline bounce, second leg. Do you see that? Baseline bounce, second leg. They come back. 13 doesn't really cross the 50. You might be like, I don't know. That's not really my level 1, but they give you a 1350 no cross safety. Shift over. Again, Thursday, being pains in our asses. But dollar CAD is something that I would hold over the weekend. Right down here, and here we go. Projection. You got to look to the left. Where am I going to project to? Well, that's massive trap volume right there, isn't it? Pin, before they rise, they roll down. They hit into that area. They slightly break that trap volume. They gap up. News. Another 1350 no cross safety. Look at that second leg. first baseline bounce. We have 2 days of divergence, baseline bounce. Comes back up, baseline bounce. And it's just over. 2 quarter points away. Now, you might scale out, get back in over here. That's up to you. I'm just giving you the basis for where I'd like to get in. I like to get in near the low, near that peak, and that's what I look for to get in the peak, the baseline, stuff like that. So I think we might have a little bit more time. Let's take a look. Actually, I'm sorry, we don't. I know you all heard Steve's presentation a couple weeks ago, and he'd like to keep everything down to about 45, 50 minutes. So we're at that 50-minute mark, so I'm just going to leave you with this. I need you guys to homework this stuff. We covered a lot of material, not really too much anything new, but just covering all the questions people had and trying to clear up some confusion. But you all need to work on this stuff. You need to go back. You need to do static homework. You need to go back and you need to do bar by bar exercises after you've done the static homework. Keep a list next to you and look for all this stuff. Don't just bar by bar the stuff and just well, I think this is this and I think this is this. When you do your static homework and once you've understood, like, okay, I'm looking for very specific things, and that's all I'm looking for. And really, if I look for this stuff across all these different pairs, I'm going to find this. So do your static homework. Do a lot of it. Do 2 25-minute sessions per day, and then do 2 25-minute sessions of bar by bar stuff. But do the homework, do a lot of it, and send me emails. Send me questions. You got to ask. btmmswing@gmail.com. I know there's some people that have sent in some homework in the past couple weeks, past month, that I haven't even gotten to between the surgery and some other stuff that's come up around my day-to-day life that's just kind of been piling up. Haven't been able to really get to it, but I will soon, hopefully. But instead of just sending homework, send some snapshots and say, is this right? I was thinking that this was that baseline bounce thing you're talking about. Is this in the proper context? Tell me what you were thinking. Don't just send a picture and say, is this right? Because there's not much I can do with that. So homework, ask questions. All right? Until next time, peace.